I'm Dan King. Thanks for tuning into this webinar on underwriting in a post-pandemic world. As well as having a fantastic panel of experts for you today, we'll be giving you a sneak preview of the results from our inaugural underwriting report. For this report, we've analysed the underwriting performance of the 25 biggest general insurers in the UK over the last 3 years. We've compared them with each other, scored and ranked each one. We'll share a summarised version of this report once published, which should be in the next week or two. Now, the last 12 months have been tumultuous for insurers, to say the least, but the pandemic has impacted different markets in different ways. And our research has shown that while commercial lines business has suffered, personal lines underwriting performance has improved in the last 12 months. So I'd just like to introduce my Insurance DataLab co-founder, Matt Scott, who is going to tell us a bit more about our findings.
Thanks, Dan. So we've rated every insurer in the UK and Gibraltar on their underwriting results, looking at 3 key metrics: their most recent COR, the improvement in that COR over the last 12 months, and also the 3-year aggregate COR as well. The 25 largest insurers in the UK have then been included in this report, where we've drilled down more into their performance, both at an aggregate level and across individual business lines too. And across the whole of the market, we've given UK insurers an average underwriting score kind of across those 3 metrics of 63% for 2021, which is slightly up on the 62% from a year earlier. And for those insurers that write solely commercial lines, that figure is a bit lower at 61%, which is 2 percentage points lower than they achieved in 2020. And when it comes to personal lines insurers, as you said, Dan, they fared a bit better than that with a score of 69% for this year, up from 65% in 2020. And if you look at insurers that write both PL and CL, they've received an underwriting rating of 63% for 2021, which is up from 61% last year. And if you look across kind of all 3 years of the analysis, then those insurers that write both forms of business, so personal lines and commercial lines, they've, unsurprisingly, I suppose, had a much less volatile underwriting score, which obviously helped by them having a much more diverse book of business.
Yeah, okay. And have there been any particularly strong or poor performances across the different business lines that we've analysed?
Yeah, there's been some clear winners and losers really across those different lines. Medical expenses has actually received the highest underwriting rating in our analysis, with a score of 67%, which is actually 2 percentage points higher than last year. And medical insurers have, of course, benefited from a reduction in claims in the wake of the pandemic, mainly as a result of a lot of the private hospitals suspending services for a period of time to help the NHS and ease kind of the burden that their services were placed under. As well as, people cancelling or postponing elective procedures because of the threat of COVID-19. And the other big beneficiary of the pandemic in terms of underwriting performance has been motor insurance. Now, it's been well publicised that driving miles have dropped since the start of the pandemic, and the subsequent drop-off in claims has helped motor insurers, and our underwriting rating has jumped by 6 percentage points to 64% this year. And that was actually the biggest increase across all of the business lines over the last 12 months. And I know we're going to speak a bit more about that in the panel discussion later on. At the other end of the scale, credit and surety insurers have seen the biggest drop in their performance over the last 12 months. Their average score dropped by 13 percentage points to 58%. I suppose that shouldn't really be surprising given all the various pressures on businesses and supply chains too, from the likes of Brexit and, of course, the pandemic. But the lowest rated business line for this year is actually property insurance, with a score of just 57%, 6 percentage points lower than last year. And a lot of that will be a result of the increase in BI claims, business interruption, caused by the COVID-19 pandemic.
Okay, thanks, Matt. And we're actually delighted to be able to reveal that the insurers who have come out at the top of our rankings, all of which will be recognised as Underwriting Gold Award winners, will be Fidelis Underwriting, LV, HCC International, and eShore. So well done to all 4. I'd now like to introduce the rest of our panel. So please welcome Insurance Times Content Director, Saxon East, and EY General Insurance Market Lead, Tony Sault. Welcome to you both, and thanks for being here. Before we get started, I just wanted to point out that we want to make this session as interactive as possible. So please do submit questions by clicking on the Q&A tab at the bottom of the screen, and I'll try and weave these in as we go along. Now, Tony, if I can come to you first, What do you make of the results of our analysis, particularly looking at the difference between commercial and personal lines insurers, as well as how things might play out in the future?
Yeah, thanks, Dan, and good morning, everybody. I wish I'd put a more glamorous shirt on now, looking at Matt's shirt, by the way. If I'd have known he was going to dress like that, I'd have made a bit more of an effort. But yeah, anyway, so in terms of the results, I guess not really a surprise that personal lines scores better than commercial lines. Yeah, we do analysis of the market, as many of you know, and looking at the sort of the motor and property markets, and obviously the motor in 2020 got its best year ever on record in terms of its CORs because of pandemic related vehicle traffic usage going down, which we'll probably explore a little bit later. So no surprises there. I guess the reason, part of the reason for the commercial lines performance is clearly, as Matt and Dan have said, about the property claims, the BI claims coming through on the property line. But also, if you go back when the premium was actually written, we were operating in a soft market, or a softer market than it is now. So that premium coming through into 2020, 2021 is probably less than the claims that we're starting to experience, and no one predicted the sort of the COVID BI sort of issue of claims coming through. Clearly that's moved now, and obviously there's quite a lot more of a harder market in commercial now, and the market is exercising underwriting discipline to sort of correct rates and get back on a better footing. So I guess I'm not really surprised that there's quite a divergence between the two performances, because as you've said, really motor has been driving, and it's a big market, it's the largest market by line of business in the UK. That motor result's really going to be pushing the sort of performance of the personal lines writers up.
Yeah. Okay. Thanks. And now the pandemic has obviously had a big impact on performance over the last year, as you said. But Tony, when you look at personal lines, and I'm thinking particularly of motor here, how do you see the market reacting as things start getting more back to normal?
Okay. So I think let's just try and put this into two or three areas. That there's the challenge around, or not the challenge, but the reduced vehicle usage. What we saw during pandemic has now almost returned to normal. So the vehicle traffic is almost back to pre-COVID levels. What is different, and this is where the underwriters are very interested in, is how that pattern of traffic, and the volume of traffic, when it's the density of traffic, as we call it, when people are driving, when they're not driving. So that mix of density of traffic has changed quite a bit in terms of people not commuting because people are working from home, therefore not going to the office. Other people being concerned about travelling, using public transport. So some are using cars now instead of public transport. So all of these things do play in to the underwriters' minds when you're writing motor business. But that's the first thing, and getting hold of that data to understand how to price that in going forward is quite tricky, because no one quite knows how. It's hard to predict how vehicle usage will settle once we get over the pandemic. That's the first thing. I think the second thing then is, I think some of the it might not be popular for saying this, but quite a lot of the underwriters and pricing actuaries, etc., have been a bit under the covers this year, focusing clearly on COVID, but also getting ready for GIPP, General Insurance Pricing Regime, and getting their pricing and rating models ready for that regime change in January, which is going to be a huge, fundamental change to how we write business. So there's been a lot of hard work and effort getting ready for that, and depending on what type of insurer you are, writing what type of business, you'll take different strategies. So we've got that underway, and I think a consequence of that is we haven't really seen much product innovation this year from the traditional or the established players. I think we'll see quite a bit of that next year. I think they are working on those things, but they're waiting till next year, because this year has been focused on preparing for the regime change, I guess.
Okay, thank you. Actually, we've just had a question come in from John Rigby, who's asked, do you have any predictions about the motorcycle market and where that might be heading in particular?
I don't. I have to say, it's not one I follow. I talk about the motor market, and I know what the predictions are for that, but the motorcycle market's slightly different because it's a bit more seasonal. Clearly, we've had some challenges recently that Saxon and his team have been reporting on in terms of provision of capacity there. All I can say from a broader motor market is that we are expecting, a sub 100% COR in 2021, at 97%, we think, but that is going to change quite dramatically in 2022 to about 112%, because we're going to start to see, the soft market that we've seen in motor this year, and the claims inflation, which I'm sure we'll probably talk about a little bit later on, is going to really start to bite the motor market. Okay, and that will affect the motorcycle market as well, but to a different degree.
But that brings us on rather neatly to the next question, which is to Saxon, really, because I know, Saxon, you've been looking at this quite a bit, but claims inflation obviously continues to have a big impact on the motor market. So what have you been seeing here, and how do you see that developing?
Well, I'd like to talk a bit about claims inflation, and in particular, how brokers are going to handle this. So obviously there has been some, quite impressive claims inflation. That's put some deterioration on some of the results. I noticed Ageas's results recently did actually show the combined ratio deteriorating a little bit, because of, I think it went, motor underwriting profitability slipped to 92%, up from 87.2, and it's claims inflation which is really causing this. We all know the reasons why. The cost of imports is going up, Brexit, supply chain issues, etc., etc. By the way, not just in motor, even in home as well. Things like decking is becoming more expensive. So there's an inflation across the piece with materials. And that's the real challenge for insurers at the moment. Not so much the frequency, but the severity of the claims inflation. And then that feeding through to the broker, because as we know, a massive part of the UK market in motor is still intermediated. And some of those players who are really big into intermediation, like Ageas, Aviva, Allianz does quite a bit, AXA, they will look to their brokers, and they will look to their brokers thinking, what can the brokers do to help us achieve better profitability and underwriting? And one of the things brokers can do, that personalized brokers in the motor market, is really about a very good understanding of their data. I know data has become a bit of a cliche, but I was doing an interview with iGo4 recently, and that's a very data-led personalized broker, a great example. And for example, it can provide data around electric vehicles that can help insurers in their claims process. Insurers worried that their electric vehicle might be put in repairs for many weeks on end, might be able to manage that process quicker and not have to pay so much because the broker's supplying better data to them. They've got software systems which the insurers could go into to help them price and underwrite better on certain types of vehicle. And that's the key really for the brokers, personalized brokers, I think, is to find the areas of the market where they can be specialists. So that could be taxis, it could be connected cars, it could be electric vehicles, those kind of things, and build data around that. And with that, supply that information to insurers, and they themselves will then get better products and better rates. And we've seen this phenomena of brokers getting data. A lot of them are good at it. It's just that it's going to be an increasingly important phenomena for intermediated personalized brokers going forward. So, and that wraps into, as I say, to the whole claims inflation piece, with insurers looking to manage their costs. So really the bottom line of the message is that in the UK market, I believe brokers have a very, very important part to play in helping insurers achieve underwriting profitability.
Okay, great, thank you. And Matt, I think you've done some interesting research around claims inflation too, haven't you?
Yeah, that's right. So kind of aside from the repair inflation that kind of Saxon was speaking about, the personal injury claims have also played a big part in driving up costs historically as well. And kind of we actually compared a couple of data sets from the data we have on our hub, and that was the average damages paid out through the Ministry of Justice RTA claims portal and the average motor price increases as monitored by Consumer Intelligence. And we ran some statistical analysis on this, and we found a strong correlation between the increase in damages being paid out through the portal and the premium movements, so the increases we're seeing in kind of premium prices. And in fact, for every 1% increase in the premiums, that corresponds roughly to about a £720 increase in average damages. Now, there's obviously many more factors influencing these prices than just the cost of these bodily injury claims. But I think it's still interesting to see kind of this correlation at play here. And if you add in the kind of the new claims portal that was launched earlier this year, add that into the mix, and suddenly you have a lot of downward pressure on premiums. But with other costs going up with kind of the inflation and kind of the stuff Tony was speaking about earlier with the different traffic mix, I suppose the real question is, what are we going to see with those prices? Now, consumers are kind of certainly expecting prices to go down. And we know that the regulator is kind of what they've said earlier. But there's still a lot of talk going on about a hardening market, mainly as a result of kind of the JIP rules and kind of that bounce back from the pandemic as well. So it'll be interesting to see how this plays out. But kind of, I wouldn't say it's foregone that kind of going forward, we'd have this correlation still between kind of claims inflation on the personal injury side and premiums. I think that could be changing going forward.
Okay, thanks, Matt. Before we move on to a slightly different topic, we've got a couple of questions that have come in relating to motor, so I thought I might ask these now. I'm not sure who on the panel wants to answer them, if anybody, but I'll put them to you and you can let me know. One is from Ian Hughes, who's saying that this is a time of year when reinsurance prices change in P&C and motor. And are we seeing reinsurance leading any change in this area? Because that might feed through into changes for underwriters. Does anybody here want to kind of answer that one?
Tony, do you keep insurers as part of your analytics and data monitoring?
We don't. No, not on the insurance data.
I mean,
we don't really cover the reinsurance
EY.
market.
So I think, I mean, we're in December now, so this is one of the main reinsurance renewal periods. I would say reinsurers and even the underwriting part as well. There's quite a bit more. In this commercial and personal, they're exercising quite a bit of discipline, particularly in commercial lines more than personal, I think, in terms of pricing. So I think we'll see a slightly harder stance from the reinsurers this year. That said, we've had you have to look at this by line of business rather than overall portfolios. And obviously, clearly, motor has been performing really well. So it's quite hard to justify reinsurance rate increases on the motor book. But then, as we've said, we're looking at reinsurance for the years going forward. We're seeing return to normal traffic volumes, right? Frequency is down on claims, attritional claims, but also the severity is up because of supply chain, disruption, inflation on parts, getting the semiconductor chips for vehicles to repair them, which has knock-on impacts to sort of, repairs and hire cars, etc. So I think, the reinsurers will very much have that in mind, along with, the more macroeconomic environment they have to factor in around interest rates, level of inflation for the whole year, plus, the performance of the financial markets next year as well is all plays into the mix. So I think it's going to be it's going to be very different depending on different lines of business. I think you have to take each one, and we haven't got time to go through each one today, but I think motor will be okay. There'll be some strengthening, I think, stiffening of resolve or pricing across the piece, which will then play into sort of what the carriers decide to price for next year as well.
Yeah. Okay.
I think motor insurance, interesting. I went to obviously Monaco a couple of years ago and spoke quite intensely to Munich Hanover Re and the chief executives there who were doing motor insurance at the time about it. And interestingly, they were saying to me the real challenge they had was more the discount rate, for example, big features like that, which are quite complex and unknown. They were very much had a real challenge around that and what their pricing should be and the impact on that. But I think the more sort of rudimentary stuff like claims inflation, frequency, I don't imagine it'll be nothing unexpected, put it that way.
I think the bodily injury rates and the frequency and the severity that Matt's talked about in his analysis is more of a concern, because at the end of the day, they're there to pick up the big, really big claims. And if if you're seeing that correlation, then that's the one they're going to be worried about. Property's a very different game.
Yeah.
We've got storms at the moment, but in the scheme of things, these are stuff that the insurers will just pick up because it's just one of those. It's an event, but it's not a major event, so it might not trouble the reinsurers actually at all. It's only when we have more significant sort of weather-related events that the reinsurers, they will then need to step in. But I think it's the sort of the really big bodily injury claims that the insurers are worried about, and the discount rate is one.
And they were looking, Hanover, I think they were talking about 2025 being the next time there could be a change to the discount rate. They were really eyeing that as a year would have to keep their their eyes on, basically, for the challenge of dealing with that. And that was the main concern for them about the UK market. That's the feel I got, very much so.
Okay, great. Thank you both. I just wanted to remind everybody who's tuning in that as Ian and John have, you can submit questions using the Q&A tab at the bottom of the screen. But moving on, Tony, just how much is the emergence of new forms of data affecting the underwriting market? And do you see this changing the types of players we're seeing in this space, particularly around things like embedded insurance?
So data is the lifeblood of an underwriter's work, and clearly things have changed, and more data is becoming available through the emergence of new technologies, whether it's the Internet of Things, new sensor technology, the technology that's embedded into cars, etc. And you can see, if you look at the entrants this year, i.e. 2021, quite a lot of the new entrants there, and there have been a number of new entrants in not just motor but other markets. The insurtechs or fintechs, telematics usage-based insurance. There's quite a swathe of new players coming into that market. Powered by data, powered by more specific insight that they've gained from that data that's captured by the vehicles or the driver behavior from the dongle or the app or whatever they're starting to use. So we're certainly seeing a rise of data fueled sort of new entrants coming in, whether that's brokers, telematics providers, and actually there is a couple of players in the wings, well documented, that are carrying the risk capital as well, that are going to enter into the motor market next year, powered by data, powered by AI, etc. So it's ever more important. But from my perspective as a consultant, we've always said it's about using first off, use the data that you've got already. That's the best data you're going to have, right? Then start to look outside the box, outside your own organisation, to bring in those other third-party proprietary data sources to enrichen that. And it is a data arms race. Again, sorry to use another tired cliche, but in the markets that we're in, whether you're in the volume market, your retail is detail, and the detail is getting much more specific around differences in slight differences in segments, etc. If you're in the niche markets, more specialist markets, again, the reason brokers exist, for example, is because they have a better knowledge and an understanding of that market, that niche, or that particular, the characteristics of that market. Well, how's that come about? Because they understand the data, they understand the information, they understand that market better than anyone else, and insurers, the carriers find that attractive. So it's just going to continue. It's just going to continue.
And just going back to the broker, it fits in again with the broker. Brokers must work out where their specialism is and then get the data to match that. We've actually seen in the last 10 years some brokers, some quite big brokers, I won't name them, but fall by the wayside simply because they're just writing vanilla business en masse. I think that model in distribution is going to be very challenging for brokers doing that. Whether it be young drivers, convicted drivers is quite big now, but electric vehicles, connected cars, whatever it may be, taxis, that's where the brokers can really shine, and that's where the market will continue to turn to for brokers.
I think the other challenge to that, I would agree with what you're saying, Saxon. On top of that, back to Dan's point about the embedded insurance, we get all these new data sources. The challenge is ownership of that data isn't necessarily the preserve of the going to be the preserve of the brokers anymore, or even the carriers. It's going to be other brands, whether it's motor manufacturers, whether it's the smart home meter owners or the utility companies. So there's and with the advent of open finance and open banking, we will enable and power quite a lot of this connectivity and ability to tag on insurance to whatever purchases there are at the point of sale or during consumption on a pay-per usage, more like embedded or subscription style basis. I think we're going to see quite a lot of a lot of new innovation coming out in and around that over the next couple of years. Still early days, but some of the foundation stones are starting to get put in place to allow that to happen from a technology perspective, from insurers understanding the data better, And then obviously, you know, things like regulation around open banking, open finance, allowing or facilitating some of those things to happen. And also, if you think about affinity and corporate partnerships, that those brands, whether it's a bank or a retail, a supermarket, et cetera, are all, you know, getting much better and more savvy around, you know, understanding what they can do with their customer base. And, you know, financial services still is a rich source of revenue for them. So I think we're going to see quite a bit of movement there. It also presents a real challenge because the OEMs, i.e. the motor manufacturers, might decide, like Tesla, that they know better than anyone else, they can do it themselves and write the business themselves, which is exactly what they're intending on doing.
Yeah. Okay, thanks. And Matt, what are your thoughts on this in terms of the changing types of players we're seeing?
Yeah, it's really interesting hearing Tony talk there about the data ownership, because I think kind of that's going to be a key thing going forward, because as you were saying, kind of it's not necessarily going to be the insurance company that owns the data, that they'll be underwriting some of these used to underwrite some of these products. And I think partnerships are going to be really key, and we've started seeing that a bit already, you know, kind of with some of the challenger banks as well. So kind of writing travel insurance policies that, you know, instantly kicks in kind of when you travel abroad. And I think kind of things like that are going to be more commonplace going forward. That usage-based or kind of short-term insurance, I think, will be key. And that'll be different kind of for underwriters to grapple with. There'll be a different way that they have to go around doing business. Kind of a lot more automation and a lot kind of for those types of products. And that'll change the market a bit. It'll change kind of revenue streams as well. And I think kind of that's great for these insurtechs coming in and these fintechs kind of partnering as well, because, you know, growing through partnership, it's a real kind of accelerator for them. It can open up new markets that maybe they couldn't access on their own. And then for the insurers, it's kind of new and cheaper distribution channels and kind of new products that can also kind of get more touch points with the customers as well. I mean, there's some banks that kind of, if you subscribe up to their premium products, when you buy something, you're instantly covered for accidental damage or loss for a period of, I think, 6 months or something like that. That suddenly gets kind of insurers a lot more engaged with their customers, more of a kind of a regular stream coming in that isn't just that kind of once a year renewal kind of touch point. And I think that'll change things quite a bit for underwriters, and it'll be interesting to see how that develops going forward, really.
And Saxon, what role would you say MGAs play in this space? And is their role, do you think, likely to change in the future?
Well, the first thing I want to say about MGAs is, and this really came across at our Broker Fest and on our surveys, is they really did step up to the plate during the pandemic. They gave good service and they stepped in where insurers failed, basically. The broker view of the insurer service during the pandemic has been dreadful. I mean, they really feel very let down by some of the insurers. And the MGA stepping in and doing a really good job, essentially. Obviously, the problem with MGAs is they don't have the distribution width that the mainstream insurers have, so they can't fulfill all the needs of the brokers. However, going forward, I think we're seeing now some really clever MGAs. And actually, I think the real innovation in the market is being driven by MGAs. A couple of examples. You know, Sequence is a ground-up data-led MGA that uses automation and machine learning to populate policies, for instance, making things quick and easy for the broker. You've got, you know, MGAs like Flood Flash. That is a fantastic innovation, using parametric insurance. You know, they stick a sensor outside a building that instantly can judge the amount of water going through and then can pay the claim instantly. A fantastic service for the customer, great for the brokers, and they're partnering with brokers. So you're seeing all these sort of, you know, Adiona, I think, is an MGA starting up in Gibraltar. You know, that's looking to use data and machine learning to offer a superior service. So I think some of the real innovation in the market is really coming from MGAs. And I think insurers have to be careful in the long run because, you know, the capacity is flowing through into the MGAs, also from the reinsurers as well. And it may take many, many years, but if insurers aren't careful, the market could increasingly turn towards MGAs for customer service, and they could begin to lose some market share. It will take time, a lot of time, but, you know, that's where I see the innovation coming from. And, you know, I've got only good words to say about MGAs at this moment in time.
Okay, really interesting. Thanks, Saxon. Just one thing to say on that. I know Adiona fairly well and what they're trying to do. They're actually starting up as an insurer, a Gibraltar regulated insurer rather than an MGA.
Sorry, my fault.
That's right. I thought I'd clarify that to people.
And the owner's insurer, yes.
But yeah, so Tony, does all of this change have any impact, do you think, on the role an underwriter plays, and kind of, do you think the role of an underwriter is changing, and what does that mean for their required skill set going forward?
I'd echo the comments Saxon made around sort of, I think over the last couple of years in particular, the new stuff or the innovation, the new propositions have been fueled by MGAs, you know, and that's sort of, you know, well, whether it's your pure broker or MGA, that's where sort of quite a lot of the product innovation happens anyway, because the brokers are entrepreneurial, they're closer to the customers, and they've got a better early warning sensor system or a nose for where, you know, things are changing and what needs to happen, because they're in constant contact with their, you know, the customer base, and the insurers are a little bit removed from that. So it's not a surprise. I do think my view is that the carriers will come back in next year a bit stronger. Okay, once GIPP is in place, you know, if the pricing difference isn't there anymore as much as it is now pronounced, then how are you going to attract or retain your customers? You're going to have to offer, you know, a better, more attractive proposition to keep that customer or attract that customer across, if price isn't the only thing anymore. Okay, so I think that's going to be, yeah, that's going to put pressure on the underwriters to think about how to innovate. Okay, what else can we do for the customers to attract them, to keep them, etc. What else can we do to help the brokers, support the brokers, whether it's a broker or an MGA or both, to capture, you know, market segments? Because if you look at the mainstream, they're all sort of trying to expand, they're all trying to grow, not shrink, and the only way they can do that is by moving into adjacent lines of business, or even just segments of business they're already writing. So again, you know, the challenge for underwriters there is how to get the data. Again, back to data. What data do we have, or can we get access to inform us to how to underwrite and select risk, you know, in segments we're not as familiar in? That makes sense. Or just get more granular about how we analyze our performance in our book, so to try and write that business.
Okay, yeah, thank you. And Saxon, I think you've seen some interesting developments around automation in the broking space that's helping to bring down operating costs. Do you want to talk about that a little bit, please?
Yeah, it's something that's been in the market a while, but I think it has been accelerated in the past 18 months. And it's just essentially brokers using automation to carry out some of the rudimentary processes, and, you know, some of the back office stuff. But this can really, really save brokers a lot of money. You know, they can reduce their operating costs substantially by using automation. And a lot of brokers are doing it. But if you're not doing it as a broker and you're in the wider market, then you really, really should be, if you're in the personal line space, because it's a very efficient way of doing business. You know, also the use of chat boxes continues to increase. So I think automation has a big part to play in keeping costs down.
Okay, thank you. And Tony, how are things like AI and machine learning impacting on underwriting?
Yeah, I think it's still quite early days, actually, on that. Just before I answer that, just the automation point, and the two are linked, because, you know, beyond automation, there's become sort of more machine learning, intelligent use of, you know, algorithms, etc., to actually start to make some decisions. Whereas automation is very much, you know, it's like, is it yes or no? Do this, yeah, do that. I think part of the automation we've seen in the industry is down to some of the platform replacements that have been happening over the last 5 years. It just, some of the processes just get removed or automated and are done by the system, because a lot of the work brokers and, yeah, insurers, sales and service and underwriting stuff are doing is porting data around, or cutting and pasting and shifting things and filling in forms electronically. Some of that is starting to, you know, get eliminated, and that trend will continue. I think machine learning and AI, you know, still early days. I think, you know, before you start playing in that pond, you really need to get a fundamental understanding of your data and your data sets and your models. And again, as I said before, this year it's been much more about getting those ready for the new regime change next year. But we are now starting to see, you know, AI and machine learning being deployed in small segments, try it out, test and learn. The newer players definitely are coming in with that as a calling card, for want of a better word. Now, as far as the customer's concerned, they don't care. Why would you care if it's machine learning or not? They don't care. It's what happens behind the scenes that's more important. So they might call that out to the industry that we're using AI and machine learning, but frankly, the customer doesn't care. They just want a good product, the right price, and a good service at the back end if something goes wrong. But evolution, it's an evolution. We're going to just continue. We will start to see more and more of that. And we've seen a bit more in the personal line side, I think, in terms of automation and application of that. But if you look at I did when I was just thinking about sort of preparing for this session today, when you sort of type in AI and insurance, the first sort of dozen things that come up, or maybe not first dozen, but it's very much on the property side. So there's a lot more in and around property, and I mean home and commercial property, buildings, sensors, etc., using AI, the data that building emits to sort of regulate, modulate, inform insurers and brokers and the risk managers of those buildings or those companies. So I think we're seeing more of it on the property side than motor actually at the moment.
Okay, all right, thank you. And Matt, if I can come to you next, how do you think regulation is impacting on underwriting and how insurers price their policies?
Yeah, cheers. I'm just quickly on the point kind of Tony rose there about kind of property. I think that's really interesting because we're all seeing a lot of things like satellite imagery, kind of particularly in the US, and there's a lot of that going on, helping with kind of things like wildfire risks and kind of managing the increased exposures they've got there. And I think kind of going forward, we're going to see a lot more of that. I know there's lots of stuff being done around kind of flood insurance over here with kind of weather sensors and kind of satellite imagery having to pick up kind of particularly risk prone area, flood risk prone areas, and kind of where the kind of water may be kind of sitting in a storm event. And I think that'll have a big impact on kind of property bits going forward, and hopefully seeing kind of how that forms so kind of low, kind of poorly in our rankings, we might see that kind of picking up over the next few years, especially kind of with the BI claims kind of subsiding off as well. But on kind of your question on regulation, Tony mentioned kind of the GIP rules that are coming in, and I think undoubtedly they're going to have a big impact on pricing, not just in personal lines, but commercial lines too, although kind of will have a bigger impact in PL. And I think one of the biggest changes is obviously the end-to-dual pricing. So insurers have to kind of offer the same price to renewing customers as they do to new ones. And for those insurers that have price walked a lot in the past and maybe have quite a sizable back book, that change is going to be huge, and they're going to have to put prices up to some degree at least, and that's going to push kind of average prices up across the board. That's for new customers, and then kind of for renewal prices, they're likely to come down to some degree at those insurers. And research has shown that big price reductions at renewal can, somewhat counterintuitive, I suppose, lead to more people actually shopping around. That's going to have a big impact on the market and kind of will change strategies and kind of approaches to pricing quite a bit, I think. But I hope that kind of those changes, along with things like the fair value rules that have come in recently, could help actually shift the market away from price and pure focus on price and more towards things like kind of service or the customer experience being off. Obviously, it remains to be seen if that will be the case. But if it does, that could actually be good news for insurers, because obviously they're not in the race to the bottom in price. And our own kind of research has shown, looking at customer experience, that relationship between the CX being offered and profitability. Insurers that have a higher CX score in our research are also reporting better CORs kind of. So, it shows that offering that good service is good for business as well, makes financial sense, not just kind of necessarily being the right thing to do. And, it should help with things like loyalty as well going forward. So hopefully that's a change that can kind of help offset some of the other challenges facing insurers in this space.
Okay, thanks. Tony, how do you see these regulatory changes impacting on pricing?
Well, we're seeing them already, aren't we? In terms of people, pricing quite keenly to build book this year, with a view that next year they want to hold on to that, because as Matt said, the pricing will sort of be less volatile or level out to some extent between new business and renewal pricing. I think there's always going to be the market will evolve and there'll always be a better deal, potentially a better deal, but the differences we see today won't be as pronounced. And actually, I think the insurers sort of comfortable with that in a way, because they couldn't get rid of this dichotomy of new business versus renewal pricing themselves. So it took the regulator to come in and set the parameters and the guidelines down. So that's still going to get washed through. The one that I guess that's more interested is going to be how the FCA Consumer Duty regulation gets applied and interpreted, because it's that's quite broad and they say it's fundamental. Not my words. They say it's a fundamental change to the way insurance will get looked at going forward. And at the moment, I think, correct me if I'm wrong, they've opened a consultation on what that's going to look like to the industry, because it's quite broad. It's quite broad at the moment in terms of its aims, intent, etc. It's not very specific in terms of what the industry, and I mean the distributors and the carriers, are expected to do to comply with that sort of that new regulation. So I think that's going to have a pretty big impact going forward. The one we haven't mentioned, which is coming, is regulation around, or reporting at least, requirements around ESG as well. So insurers, along with other industry sectors, it's not specific to insurance, but there is going to be a requirement to provide reporting to the regulators around your commitments to and how you're managing your ESG exposure, footprint, contribution to, etc. products, and so on and so forth. And that is really just starting to sort of get some headway. So we're going to see quite a bit of activity, I think, in and around that as well from a regulatory perspective next year.
Okay, thank you.
A few things for me on the regulatory perspective. For the brokers, not quite tied into pricing insurers, but for the brokers, the big question, I think, is premium finance and what the FCA is going to do there. Because if the FCA comes down quite hard on premium finance, which is a massive earner for brokers, that could really affect their business models quite negatively. So I think there's a real hope that the broker will understand what an important part of revenue it is, that will give some brokers some leeway. Brokers will have to show their kind of essentially benchmarking and not charging too much an interest rate out of line with others. But there's hope, I think, that the FCA will show some leniency here, because they could really crush the distribution market if they come too hard down on that. So that's one very important thing to play out, which we don't know exactly what's going to happen there.
Just to add to that, Saxon, before you go on to your next, just on premium, it's a really interesting point, because whilst it's quite a rich revenue source for brokers, it also does meet a need. A lot of people can't afford to pay their insurance up front. So whether that's I think there are studies out there, and I can't remember but they reference the fact that the affordability of insurance is quite difficult for quite a large proportion of the population. And so whether it's premium finance or direct debits or using the insurer's credit facility, is quite an important part to get them over the fence to getting some cover. So it's not just they're a bad play. It's just they actually do provide a service. Now you can argue the economics of that, whether it's for them or the brokers, etc., or the insurer, but the affordability issue is a big issue for end customers. How can I afford my insurance?
Absolutely. And just very brief on that, I couldn't agree more, because, and I know some of the brokers have actually had conversations with the FCA. They say the FCA's listened, and they've said to the FCA, look, as you absolutely rightly point out, Tony, this is a very essential part of giving affordability and insurance to certain drivers. And there has to be some kind of interest rate attached to it, because there is a slightly higher risk. You have to understand the dynamics of this situation. And there is a real fear at the moment, and I think quite a valid fear amongst brokers and indeed some insurance executives, that the FCA has had so much change, so many different personnel coming in. I mean, I just can't keep track of it. People there who've got no real experience in non-life insurance, dealing with massive issues. So I think, there's real hope that the FCA does listen to people who've been in the industry a long time on these absolutely key issues. Sorry, Matt.
No, that's fine. So, yeah, I think kind of one of the things I'd say is, yeah, definitely agree. Kind of premium finance, kind of paying installments definitely has a place. It's a key service for a lot. But I think kind of a lot of the things that the FCA might be picking up on are the kind of the interest rates being charged compared to kind of other areas where maybe in insurance, kind of that credit risk isn't as high because, if someone stops paying, you can always cancel their policy. So I suppose that's kind of one of the things that the regulator could be looking at is kind of the amount being charged for these services compared to the risk being taken on. And I think when you see kind of, but Saxon mentioned how much kind of these revenue streams are for brokers, the big part for a lot of the insurers as well, and, particularly the motor insurers, they get a lot of revenue from installment income. Sometimes it kind of, can more than, offset underwriting losses they're getting, similar to kind of investment returns. And I think kind of if the FCA does kind of make any changes in the space, it could have a big impact, not just on kind of the distribution market, like you were saying, Saxon, but on insurers too. And it could really hit some of kind of their overall profits quite hard if there is a big change there and kind of the amount of interest that they can charge does get slashed.
Absolutely. Yeah. It could affect some of the business models. Absolutely. Installment income, huge.
I'm just going to throw it open because we've got a couple of questions come in on the chat. So I'm going to put these to the panel. I think, Matt, I'm going to ask this one to you from Andrew Waring, who's asking, why aren't insurers working with telematics companies to compile industry-wide data on the actual use of vehicles?
Yeah, I mean, I think they'd like to. I think the problem is, Tony alluded it to earlier, is kind of the ownership of this data often lies kind of with either the telematics firm or kind of increasingly with the actual kind of car manufacturer. And they know the value of that data and they're not going to kind of share it unless they're getting something big in return. And I think kind of sharing it more widely to get a bit more of a kind of what kind of the whole of the market's like in terms of kind of vehicle usage is going to be a big stumbling block. There's going to be that ownership and people not wanting to give away too much. And I think going forward, that could be even more of a problem. I mean, Tony spoke about Tesla looking to do their own insurance, and I think we could see more car manufacturers going down that route. So I'm sure insurers would love to get this data. I'm sure they've been trying to, and we'd love to see kind of the stats there, but I just think it's going to be maybe a bit of a hurdle to get kind of people who own that data to share it more widely, other than kind of the business partnerships they've got where it's being used specifically for underwriting risks.
Yeah, insurers would never do an industry-wide sharing data on telematics. That would never happen. It might even breach competition if they did that anyway. So I doubt that would ever happen in any meaningful way.
And there's also been a question by Claire Rule, actually, who's asked, it's a general question, I'm not sure who's best placed to answer this, and if anybody wants to answer it, let me know, but she's asking, what do you think about digital syndicates like KI, that are automating underwriting, which was, I think that was a partnership you said between Google and Brit Insurance. And apparently there have been concerns that this could impact insurtechs negatively, but I don't know if anybody has any comment on that.
Not one I know much about, I'm afraid.
Not much, but I would say that, some of them are very sophisticated in the data and the intelligence that people have got on board. And, if they can do automated underwriting, which I imagine would be, because I don't know much about the individual, but if they can do that effectively at a cheaper cost to the customer down the line, then there's a need for it. But I don't know much about Key in total, so I can't really comment too much.
Okay.
I think fair play to them, right? So I think I'm sure I'll get corrected if I'm wrong, but they're a follow line rather than lead. So they're not setting the rate; they're just sort of assuming someone else is doing a lot of the underwriting to some extent around that, and then the AI is powering their decision making behind the scenes. So I think it's a very interesting model, and I think it's got some way to go. Interesting. Others haven't followed down that yet, and we'll see. But it's a follow syndicate, I think, rather than a sort of a lead insurer. Yeah. So how the AI and the algorithms are being used, the machine learning to assess risk, is going to be quite different because it's follow rather than the lead insurer. But I think it's a great. It's a good example, and it seems to getting some traction in the market.
There's a question on premium credit, isn't there, Dan?
There is, yeah. I was going to move on to something else, but we can touch on it very briefly because we've only got about 10 minutes, well, less than 10 minutes left now. But yeah, there is a question around premium credit. It's come from Craig Polly, who's asked whether we have any grasp on default rates on premium credit finance, because his understanding is that insurance is among the lowest default risk, and this interest rate he's saying here is wholly unjustified.
Just interestingly on that, I think, and this is it's just a really interesting question because obviously with, as I mentioned earlier, with some of the customers that are being served with premium credit are actually quite risky, and there are some quite high default rates there. But the big thing about this whole issue is the FCA is saying to the insurance market, both brokers and carriers, look, how can it be that one broker, for instance, is charging 40%, another's charging 15%? And some of the brokers said, look, we use that 40% to effectively subsidize the rest of our broker model. And the FCA said that's not good enough. So I think the key thing is, there is an issue here around very, very high interest rates on some premium credit. And some of those players charging very high interest rates, that will have to come down. In the market. So it's definitely one to watch.
Okay, thanks, guys. Before we kind of bring this session to a close, I wanted to talk a bit about emerging risks and what that means for underwriters. Tony, I think you've got some interesting thoughts on the cyber market.
Yeah, so, well, I guess a few things around emerging risks, isn't there? Yeah, going back to the original sort of topic, the pandemic has changed the sort of the shape and profile of risk and perhaps some new ones. But when we get to, a greater dependence on AI, machine learning, I hate to say it, but autonomous vehicles, at some stage, that is going to, again, present a very different set of risks, and it almost becomes a more of a commercial liability policy than insuring an individual for a particular risk, because you're not really, the individual isn't really part of the mix, as in terms of risk factors anymore, because the car is going to be driven by computer, and infrastructure and everything else that goes with that. So there's a whole plethora of emerging risk going to come there. But from linking it to cyber, that also presents, a threat, as in like people take it, and you see this already, and there's reports in the press around, not nice people taking over the autonomous vehicles and deliberately, making them crash or swerve into something. So that attack, that penetration and that attack penetration sort of threat is going to become more increasingly prevalent as we sort of start to rely more on those and that sort of type of transport. But more broadly around cyber, look, that is it's been around for a period of time, but it's becoming ever more prevalent in society as we become increasingly dependent on our phones or digital infrastructure, to do a lot of things from, driving to booking your hotels to getting your food delivered, etc., etc., etc. And businesses who are digital businesses embracing digital. Every week there's a report, isn't there, in the press, or even every day, around a company that most people are familiar with getting attacked. So that cyber threat is increasing. The challenge we have as an industry is that very few people write that business, and in fact some have tried and then walked away from it. So there are very few people writing cyber, and the policies themselves, are quite big, i.e. they're quite expensive. So there isn't it's quite hard to find an affordable cyber policy that gives enough protection to consumers. But that will change. I think that'll have to change, because this risk isn't going to go away. And if you read the surveys, people are becoming increasingly, people and corporations are increasingly worried around cyber threats.
Definitely. And I spoke to CFC recently on cyber, and interestingly, I mentioned about ransomware being a big threat. Forrester was saying it could actually push some insurers next year out of lines of business as ransomware coming through. And Graham, who's obviously quite long in the tooth, Graham Newman, Chief Executive CFC, he was saying that, he's been in the market, like very seasoned veteran in the market, and every year, every sort of group of years, there's a new threat. It's going to cause massive claims. But he does say that the cyber insurance market is very skilled at managing that when data comes through, understanding the risk, pricing it effectively, manage the risk. When the data comes through, they do actually manage to overcome these different challenges. One of the big things is failed servers as well for the cyber market. The other day, Amazon went down. A lot of places in the US couldn't get businesses coming through. We know that Amazon now provides a lot of service across the insurtech insurance industry. So that is a big threat there, which is a big unknown. That's one to watch as well for the cyber market.
Okay, thank you. And Matt, I know you've done some research on cyber in the past during the time with Insurance Times. Do you have anything to add?
Yeah, that's right. So when I was at Insurance Times, we rated kind of different SME cyber products on their coverage and kind of exclusions, what wasn't covered. And kind of over the 2 or 3 years I did that, it was a couple of years ago now, but we saw a lot more maturity in the wordings. So the policies across different insurers are getting a lot more standardized in that kind of SME space. And I say coverage generally was improving, kind of the exclusions weren't being as restrictive. And I think that's a sign of how kind of the insurers were getting kind of more familiar, I suppose, and more, understood that market, area of the market a bit better, more comfortable with kind of holding those risks. But, as Tony was saying, it's been around for a while, but it is still quite immature, especially kind of compared to the more established lines. And there is still a bit of a fear from underwriters, particularly as you kind of move up the scale to take on these risks. And I'd also say to some degree, there's a bit of reluctance from brokers to sell the product, either because they don't necessarily understand the coverage that's there, or because there isn't demand from the clients. I think that is changing though. Penetration is increasing, but I think there's still a long way to go. But it'll be interesting to see kind of how insurers react to that, the kind of the types of risks they're facing, and also, as the penetration grows, the more systemic nature of the risk as well. It'll be interesting to see kind of how that grows going forward.
Okay, thank you. We've got about 2 minutes left, so I'm going to ask another question from Ian Hughes, which is going to be basically, I'm going to make this a quick fire question. So literally a very, very quick answers from each of the panelists on this one, which is A, do you think that 2022 is likely to be the most dynamic year ever in the market? So that's a quick yes, no. And if it's a yes, how would you recommend companies best stay ahead of the change and emerge stronger? So,
well,
Saxon.
I don't know where the bar's set for a dynamic market in insurance. I guess genuinely, I mean, dynamic. It's really genuinely quite fascinating in terms of.
Yeah. The question is, will it be the most dynamic year ever?
I think yes. I think it gets more dynamic every year.
Yes, I would say huge amount of change. There's a build up to this. There's everything we've talked about already for the all the different the macroeconomic environment, the industry dynamics, the regulatory dynamics are all changing. It's going to be consumer behaviour and attitudes to insurance and is changing. So throwing all of that into the mix next year is going to mean quite a lot of change. The insurers have by and large done okay. They want to grow, so they're going to have to be competitive. They'll have to up their game to get customers. So I do think we're going to see quite a lot of. We're seeing the insurtechs. Some of them are getting a little bit more mature now. We're still seeing more of them pile into the market. So adding all those ingredients into the mix, we're seeing M&A activity, particularly in the brokers, is carrying on and continuing. So I just think there's all the various ingredients of the market dynamics are quite hot at the moment. So I do think we'll see. I think it's going to be a big year actually.
Yeah, and Saxon, Matt, do you agree with that?
Yes, I think it will be the most dynamic year. I think there's some great companies coming through. There's some really exciting stuff going on. There's some great innovation. Far from insurance being boring and terrible, I think we're seeing some really quite innovative, I mentioned earlier, MGAs and insurers doing things and brokers. And I just think that's a consequence of advances in technology. I think you're getting better software, better data, better information. I think nimble, quick, fast-thinking, entrepreneurial people are taking advantage of technology, which is getting cheaper and easier to use to service customers. So I think it is quite an exciting time for the market, and it will be the most dynamic year yet.
Right.
Yeah, I'd agree. I think kind of the insurtechs coming in are going to really shake things up. I think them, as Tony was saying, maturing more now. I think they're going to have a big impact. And the new ones coming in will disrupt things quite a bit. I think we'll see kind of more partnerships with people outside of insurance, which will change the whole way the market operates. Regulation changing, bouncing back from the pandemic, consumer behaviour. I think it's going to be a lot for insurers to grapple with. In terms of the second question from me in there, I think it's insurers need to be prepared for the fact that they don't know what's going to happen, so they're going to have got it wrong. They don't know how things are going to play out next year. And being able to be kind of nimble, having a backup plan, being able to change strategies around pricing or kind of, how you're approaching the market is going to be key. Keeping an eye on what your competitors are doing, how you're benchmarking against them. I think that's going to be more important than ever. And having access to kind of information and insight that can help inform the changes that you will need to make to your plan for next year. I think that's going to be the big thing in staying ahead of these changes and being able to react as more becomes clear about how these changes are going to play out over the next 12 months and beyond.
Great, thank you. Well, that neatly brings us to the end of today's session. So many thanks once again to Tony and Saxon for joining Matt and I. Thanks to all of you for tuning in and asking your questions. Look out for the summary version of our underwriting performance report, which we'll be sending out by email to all of you in the next week or two. Insurance DataLab subscribers will receive the full report, and they also have access to lots of data and analysis on the performance of insurance companies through our digital insight platform, which includes things like ombudsman complaints volumes and upheld rates, customer and broker satisfaction scores, and comprehensive financial results. Feel free to email me if you'd like to know any more at dan@insurancedatalab.com. Thanks again for watching, and if it's not too early to say so, Matt and I would like to wish you all a very Merry Christmas and a Happy New Year. See you again in 2022, and goodbye for now.